Good morning, Richard Calhoun, Creekside Realty. Today is week 13, the end of the first quarter of 2022. We're here to talk about Silicon Valley real estate market. These URLs we'll get back to in a minute. We do have one new slide that hasn't been here before to talk about the interest rates, and that will be just before we recap. So the first data slide. What we're looking at is the blue line, the lower of the three lines. That is the total available inventory without an underlying contract of any kind on it. And you can see we're still significantly below where you'd expect. You expect to be at the 5-year median, the yellow line, which is horizontal because that's the reference point. So these are doing everything on a percentage of the 5-year median. The gray line is also inventory, but that's the number of new listings that are coming on the market in a given week. And you can see the last 2 weeks, we've been on right on either side of the 100% of normal line. Earlier in the year, we were significantly above. And when I say significantly, probably something like 110% of what you'd expect it to be. Keep in mind, my base years are 15 through 19, which were 5 good years. So if we were all on the yellow line, we'd be having a good year. Lower inventory, and then finally the demand, the red line being above yellow line, we have a huge supply imbalance shortage compared to the increased demand. And that's what's driving this marketplace. And it's more the increased demand ate up the inventory, because when COVID started, we actually had a surplus of inventory. It wasn't huge, but it was the constant over demand that ate into that surplus and then gave us a shortage now of somewhere around 30%. This looks at DUI. This is in raw count versus percentage. So the yellow line is the raw count of the DUI, days of unsold inventory, the supply demand ratio that you'd expect. The blue line is where we currently are. The lower the blue line is, the lower the DUI, the faster the marketplace is. So, we're clearly in a very fast marketplace. Yes, we slowed down a little bit, but I mean, you're below 20. Anything below 40 is a strong seller's marketplace. The purple vertical line designates between 2021 on the right and 2022 on the left. And in 2021, you do have to subtract off one. Week 15 is actually week 14, and that's to get the separation around the purple line. This is the overbidding distribution, and the most recent line is the purple line, which is out here. It's very close to one of the best weeks we've ever had. This is the sale price to list price ratio. This is measures of how much pressure the buyers are feeling from the surplus demand. Clearly, we're now, I don't know what day number we're at on the Ukrainian war. We're more than 30 days in that, and there's been no slowdown in the real estate market that I've perceived yet. Now, it's possible we have one more week to go, figuring that when it first broke out, people didn't have time to react. They already had gone out and looked at their houses for the weekend and things. That's sort of what happened with COVID. COVID was announced on Tuesday, I think it was the 17th of March, 2020. That week was almost a normal week because everybody had already gone out and looked at the homes and everything. But the following weekend, with no open house activity, is when the market really dried. That might be happening this week, but there's really no indication on other data either. So we're still seeing a very strong marketplace. The red dotted line through here is the best month ever. By next week, I will have March of 2022 as the best month ever. And it's going to be somewhere in this pack up here and hard to see, but we'll get rid of April 2018. And it's going to be a significant improvement. It's going to be basically these 4 lines, well, March 5th through a little bit into April. We need to get to April 4th. So I need 2 more days of data in order to draw the line. And then I want to try to give people a little bit of time to report sales. So I'll probably do it Thursday. This is the same data, just less data points, so it's easier to see. And now you can start seeing the 4 solid lines, or the most recent lines. They're all at the very top of the marketplace for the most part. The light orange line, which is back on the 12th of March, that's probably the lowest of the 4. The dashed lines are the next group that are all clustered together. And then the dotted lines are clustered, but are significantly lower. These dotted lines are basically in February and back into January. So those contracts, for the most part, would have been negotiated in 2021, and the market has improved in 2022. This is finally looking at a breakdown sort of at the county level and looking at the key indicators. First, looking at active inventory. The only thing you can really pick up that you saw on the active inventory is active listings is the inventory. And what we're doing is comparing this week to last week. And I consider consider to be 95 to 115% of normal to be a normal balanced marketplace, and that would be in black. So that's Santa Clara County condos down here. The red are red hot marketplaces because you're below 95%. You can see Santa Clara County has the greatest shortage at only 62% of the inventory you'd expect it to have. That's up from 56%. In San Mateo County, it's a little bit better. It's getting closer to a balanced marketplace, 91%, up from 88%. Neither one of those in itself is a significant increase, but when you look at them, all but the condos in Santa Clara County, which is a fairly small marketplace, would have the third fewest number of transactions. And then the Bay Cities actually also went up, and it's at 221, and it's in blue because that would indicate a nice cold marketplace. This week, I did have the time, or made the time, to look into my data. My data does appear to be accurate. My best explanation on why there's so much inventory is Redwood City has added a huge number of condos and townhouses over the last decade. Those transactions are now coming back on the market. So there's been a huge increase in the total number of units that are available. So there's been a gradual increase, nothing dramatic, just gradual increase. And when you look at the 5 years, because you're going back and looking at 5 years and taking the median, you're looking at basically 3 years back in time. Now we're also 3 years past the pandemic, because 19 is my last space year. So you have 20, 21, 22, all of new construction, all of time people living in condos and townhouses. A lot of those were new homes, so those people tend to move more frequently. So I do believe my data is accurate, and it's just one of the statistical fluctuations. This is the new graph I was talking about, and a lot of clients were talking to me about the dramatic rate increase, going from somewhere around 3% to somewhere around 5%, which was a 67% increase in the interest rate. And they were going to say that's an increase of 67% on my house payment. That's going to be a drop of 67% of housing prices. And I argued, no, it wouldn't. And now I've actually gone through the math. I used roughly the median price. That's hard to believe, but $2 million. And we're looking at someone that's putting 20% down. So they're borrowing $101,600,000. At 3%, their PI payment, principal and interest payment, would be $6,700. Their property tax would be $2,167, insurance $150, for a total payment of $9,062, requiring a $271,000 annual income to qualify at a 40% debt ratio. So now what we do is we keep the payment the same, and you can see the payment's up. You know, it looks identical here, but when you multiply it by or divide by the 40%, you can see it's off by 20 cents, but that's really close. And insurance stays the same. Property taxes actually go down because your purchase price does go down some. Your PI payment increases significantly, but the amount is less than one would expect because the amount of principal goes down as the interest rates go up. The top line basically says there's only a 17% decrease in the affordability with a 67% increase in the interest rate. And then I did it at 50% debt ratio for someone that had more cash down payment. And you can see that the amount of decrease for those people isn't as significant. Obviously, if you had zero loan, 100% cash down payment, you would have no change in your payment whatsoever. With that, we're to the URLs. The green is my root URL. If you add in H for handout and the 8-digit year, month, date code, you'll get the handout. It got posted early today. You know, I try to target 15 minutes before the hour so you can get that and look at it ahead of time, or just get that and not even listen to me. And then to join us live on Saturday morning, you add in the 4-digit year code to the base URL to get to the archives. You go into the 8-digit, and that takes you to the YouTube archive. Does anyone have any questions? Not seeing anyone unmuting themselves. Now we're looking at some of the first find what's happening in each one of the micro market areas. And we're starting off with what I consider to be the 3 major components, and then sale price on the 4th, because everybody's interested in what's happening with sale price. DUI to me is the single biggest indicator. It is also an indicator that you get with the number of offers accepted. So you get it earlier in the process. It doesn't have such a lagging time. And these are basically record low levels. Anything under 40 is a strong seller's marketplace. Anything under about 20 is basically new record low territory. So you can see across the board, the expensive areas in San Mateo County are the slowest at 41, still very respectable. Your condos and townhouses are doing very well as well. Moving over to frequency. Now you need the sale price. And now you have the 30-day delay for closing of escrow. Santa Clara County, 93% over the whole county. County. Redwood City is again at 100%, and that's a fairly significant micro market area, even though it's only one city. To be at 100% now for, I think, the second week in a row is just phenomenal, because that means every single seller that closed escrow this past week got a price higher than their asking price, not even equal to, but higher than their asking price. So here's your percentage. The lowest number I'm seeing is at 78%. Again, the expensive areas in San Mateo County. If you eliminate that, I think we then jump up to 85%, and then we keep going from there. 85 on the coast and also down in South County. Then you go up to 88% in Palo Alto. It'd be almost interesting to go down to the South County area and tell them that they have the second slowest market, and they'll go, we're on fire. They are absolutely on fire, and they're on fire for their marketplace. They're on fire to anything objective, but they are the second slowest micro market area in both counties in the single family areas. And then here's your condos, and you can see the condos are getting almost as high on the frequency of overbidding as single family homes. Now moving over to the magnitude, this is how much buyers are willing to overbid. And you can see you got 122%, 121%, 120%. All very strong numbers. 119, that's another 120, 118, 117. So it just basically counts down. Countywide, Santa Clara County is 117.7%. San Mateo County is just a little bit below at 116.4. Condos are lagging behind slightly, but they're seeming to be catching up at 111%. On the pricing, the median price is the middle number, and that's what assigns the color. For counties, it's in thousands, so that right off the bat, it's something different. In the micro market areas, it's in millions. So for South County, their lowest 10 percentile price is $900,000. Their highest is 2.4 million, with a median of being 1.4 million. You can see the distribution is pretty tight, and that's fairly common. There is less of a range between the 10 percentile and the 50 than between the 50 and the 90. And that's going to be very common because of the bell-shaped curve of real estate. Pick whatever micro market area you're interested in and just look at the median and 10 and 90 percentile numbers. Then we look at the number of new listings. And here you can really see for the last 2 weeks, the blue line and the yellow line are right on top of one another. So the number of new listings coming on the market is exactly where you'd expect it to be. I see no reason why that's going to change significantly. It's been that way. It got a little bit above at the end of last year and started off this year a little bit above, not dramatically above, but slightly above. But we've been basically having the same number of sellers that you would expect to come on the marketplace. And that again is for 5 years before the pandemic. Now we're looking at the total inventory, and you can see last year at this time, there was essentially normal inventory, but it was just in a two weeks from now where we really started to see the shortage mount, and then it got bigger through here right between Halloween and Thanksgiving, which looks like it brought in some of the 2022 appreciation into 2021, and then it has remained fairly significant below the level of inventory you'd expect. In rough numbers, if I pick that number, I might say that's something like 1,150 homes on the market right now, and you'd expect just about 15-20. So a fairly significant shortage in the number of units in an area that was short in 15 through 19. This is the number of new offers. You can see that we've been above and consistently above. It dropped down quite a bit this last week. I think that's because we're basically no inventory out there to choose. If you go back for a second to the new listings, you can see the number of new listings really dropped down. Not this past week. There was actually an increase this past week, but last week it dropped down. So to get forward now and look at the demand drop down this week, that's sort of what you'd expect. Listings come on 1 week typically towards the end of the week, mostly Wednesday through Friday, and then they sell as a result of the weekend activity the following Tuesday through Friday. This drop here is nothing more than there was less inventory for buyers to pick from. The buyers that are out there now have seen everything that's on the marketplace, so they're waiting for the home to come on the marketplace, and with fewer homes coming on the marketplace, there's fewer transactions. So it's not a demand falling off, it's a lack of supply. Here's days of unsold inventory over time for the 3 counties. The red is Santa Clara County single family home, brown is San Mateo County single family homes, and the yellow is Santa Clara County condos and townhouses. You go over here to the right and you can see the lines are pretty horizontal. You might argue that San Mateo County rolled down quite a bit, and you might argue that Santa Clara County is going down slightly. To me, they're all fairly flat. DUI bounces quite a bit. There is 7 data points for every week, 1 for every day. Here's the map distribution for days of unsold inventory. So here, the red of the color, the hotter the marketplace is, and you can look just at a glance and see that right along the border is where the market's the slowest. Coast is pretty cool. Los Altos, Palo Alto is pretty cool, but the rest of the market is pretty hot. I mean, and even when I'm saying those areas are cool, those coolest areas at 42 days of unsold inventory. I mean, in any marketplace, by any objective measure, that's still a very aggressive market. Here's the frequency of overbidding over time. You can see that we're quite a bit above where we were last year. So last year at this time, we were hovering right around 80%. This year, we're basically hovering around 90%. The higher that gets, the harder it is to go up, because it only takes a fewer and fewer number of sellers getting their asking price or slightly below their asking price to keep that number from reaching 100%. Here's the overbidding over time. Same color scheme. Red is Santa Clara County single family home. The brown gray is San Mateo County single family homes. And the yellow is Santa Clara County condos and townhouses. Here's the overbidding in frequency, graphically mapped. And again, you can see some of the lighter areas, right against the expensive areas, South County and the coast. So, it's 3 areas that are the slowest. And again, when you look at them by the slowest, 86%, 88.7%, and 78%, and then the coast at 85%. I'm saying anything below 90% is the slowest marketplace, and that's insane when you think about it. 9 out of 10 sellers in almost every micro market area are getting more than their asking price. Here's the magnitude of our overbidding. This is how much. So last year, buyers were paying 8%, offering and paying 8% over the seller's asking price. This year, they're up at 16% over the seller's asking price. This is the overbidding over time. Again, you can see it's fairly strong. You can see last year we were here at somewhere just, it looks like it was closer to 110% for the single family homes. I guess the combined would be lower because the condos were at 105%. And boom, you can start seeing the increase at the end of last year, and then the dramatic increase, especially in San Mateo County with the new year. And now you're somewhere around 117% for single family homes. I think it's 117% and 118%. And your condos are somewhere around 111%. Here's the single family only distribution for the 2 counties. Again, the redder the color, the higher the magnitude of overbidding. Here is the median price over time. You can see that there are times when the prices jumped up right here in the beginning of 2021, right here at the beginning of 2022. That's typically how I perceive the market. You have a rapid run up, then a leveling off, a plateau, and then in some years, like you can start seeing it, you had a second wave of increase. It's not that common. I think last year was the second year, 2017 was the first year. So it's not that common to have the second wave, but even the second wave sort of disappeared by the end of the year. And then it wasn't until the first of the year where you had the rapid run up again. Here is the pricing distribution. Here, the white color, which is just Redwood City, is the median for both counties. The redder color from there, the more above that median price it is, and the bluer the color, the more below the median price it is. And then over here, you can actually see the real numbers. So since it's the median price for single family homes in the 2 counties now is $2.5 million. So my $2 million example isn't even that outrageous. And it's actually a little bit interesting. The base cities is a little bit below Redwood cities at 2.51. That's sort of a reversal. Normally the base cities is more expensive than Redwood City. Redwood City has just been on fire. I'm currently working up there with a buyer, and it's just on fire. I've never seen a market like that before. Here's the appreciation. This is the appreciation measured over 2021. And one of the reasons I think I'm leaning towards keeping this is look at the drop down. In the expensive areas, you're down to 20% appreciation year over year. You got down to 10, and that was after hitting 39%. Now, granted, in the expensive areas, there's a lot more range, but even on the coast, which is not really expensive properties, you were at 40% over the 2020 pricing just at the end of February, and now you're down to 20%. So part of me says that even though it's sort of awkward to talk about, what the median price is for the past week and compare it to a calendar year base, I like that because if I compared it to the same week 13 of last year, both your base and your current measurement could fluctuate and you start getting to the point where you don't have data. Here you have data and you can tell. The other thing that is interesting that you can go from this 39%, and if you wanted a year over year difference, go back to what the April 2nd, 2021 price was and subtract off the two, and you have the percent increase. Now, it's not going to be the percent increase based on 2021 price, but on 2022. So it's going to be a little bit off that way, but you could see what's happening year over year. Now we're looking at the historical data to get a 20-year history on here. And keep in mind, March data is not finalized until April the 5th. So this isn't final data. So we're not comparing apples and apples, but we're adding today, we're going to add the 2nd, the 3rd, and the 4th, this data point. Not much is going to happen on Saturday and Sunday, and not much even happens on Monday. So these numbers, even though they're not finalized, will be relatively close. So with an inventory of 542, it is going to be the lowest. I think about 2-3 weeks ago, I was thinking that I thought there was a chance we might catch 2021, but I didn't think we would. What it's really telling me is if you look at this record low inventory, you come down here to the number of sales, 1190, that is not a record low. We outperformed 2019, we outperformed 2020, which isn't a fair comparison because at this time in 2020, we would have been impacted by COVID, but we also outperformed 2017, which was a good year. Now, 2017 took off more later in the year, but even the beginning part of the year wasn't a bad year. So my point is that for years, if not decades, people have been saying the primary reason we don't have more transactions is a lack of inventory. That it cannot possibly be the primary reason because now with significantly less inventory, we sold essentially the same number of units. It might be a limiting factor, but there's something that's limiting the inventory, the number of sales more than inventory. Now you look at DUI, 15.9, basically the same as last year. I wouldn't say there's any difference. The average days on the market is lower than last year, and that tends to indicate you've been in the market, this type of market for a longer period of time, and the overpriced turkeys have gone away because when they sell, they bring the average up. So once they've been worked through, your average starts to drop. So I think that's why this number, the average has dropped down. The median is fairly consistent with the low. We had 9 days back in 2018 and 17. We had 7 and 8 days in 20 and 21, and now we're at 7 days again. DUI is essentially tied. It's actually beating by 1/10 of a day, but I don't think that's significant. The typical square footage. Now, when you come down to sale price, the buyers are way more frequently to overbid, 93% versus 83% the previous record. The magnitude of overbidding, essentially 18% above instead of something like 12.5% above. So a significant difference. The median price in Santa Clara County for single family homes is now just over $1.9 million. So my example of $2 million is actually closer to the median for Santa Clara County instead of both counties. And then here is the data for February. So we're comparing apples to apples, but looking in the rearview mirror, it's the same data. So I'm not going to go into it. And with that, I'm open for any questions. And if I don't get any questions, I'll end the meeting. Not seeing anyone unmute themselves. Have a good week, everyone. Take care. Hope to join you next week.